Hello, most of you know me. For those who don't, my name is Chamath Palihapitiya. This is my investment thesis, 2020 to 2030. Start this off by saying I am not a financial advisor. Everything I say here is my own opinion. Do your own research. What you do with your money is your choice. Like I said, whatever I say here is my own opinion. For all you know, I'm high. Well, I am, probably, most likely. I'd say I'm probably drinking a beer, but today it's Topo. Next up, you're going to need a brokerage account. Say, my favorite is TD Ameritrade. That's just my opinion. But even if you have a brokerage account already, I suggest you open another one. I'll put a link down below. It's for Webull. You open an account, you get 2 free stocks, and if you deposit $100, you get another 2 free stocks. That's not spend $100, that's just deposit $100. That $100 is still yours to invest as you see please, or not invest if you want. They'll still give you the free stocks just for putting it in there. It does take like a week to get the free stocks. It'll show up in your account right away saying which ones you're going to get, but then it takes a little while for them to actually hit your account. But they're good stocks. I mean, 2 of them that they gave me is something I already had in my own portfolio, so why would I sell them? I was already buying them to begin with, and they gave me 2 for free, so that was cool. The 2 stocks are going to add up to a minimum of $21. That's if you put $100 in, that's 21% return on your investment. So it's a hell of a way to start. So yeah, sign up for Webull. Link is down below. That'll also help me out. I get a little bit. I get a stock or 2 out of it as well. So I'd greatly appreciate it. I believe Robinhood has the same kind of deal. You sign up, get a free stock or 2. Personally, I don't use those accounts. I just take the free stock, sell it, and transfer it to my actual investment accounts in TD Ameritrade. So before we get into it, we're going to talk a little bit about what investing is. I know that seems some real high school stuff there, but try to use your adult brain and think of it very literally. This isn't metaphorical. This is all very literal. So just keep that in mind. So what is investing? You're buying a stock, which is a piece of a company. That gives you the right to make decisions based on the percentage of the company you own. The more shares you own, the more voting rights you have, the more your decisions matter. But it also gives you rights to future profits or current profits. But I don't invest in current profits. You can even invest in past profits. But that's even scarier. People think future profits are scary, but that's only people that are gambling with their money, I think. Obviously, all investments are a little bit of a gamble, but so the three types of investing in profits. So if you're investing in past profits, let's say you're investing in 3M or General Motors or Coca-Cola, Pepsi, any of these old companies that have been around, Hilton Hotels. Past performance does not guarantee future profits, especially in industries that are being disrupted. But we'll get into those later. And that is kind of the cycle of business. Even the companies that are disrupting industries now will be disrupted in the future. It's just the cycle of innovation. You can in current profits. If you're investing in current from my perspective, investing in current profits, it's safe. It's what you do when you've already become wealthy and you're just trying to protect it, when you don't necessarily need it to grow and you don't want to take the risks of that type of investment. And by risks, I also don't necessarily just mean money, because time in itself is a risk when you're investing. The shorter your time horizon, the riskier the investment is, because in the short term, the stock market could do anything. In the long term, the stock is going to move based on the company. But sometimes it takes the stock market, and when I say the stock market, I mean you and me and whoever else is buying stocks. We are the stock market. We are the market. The market can do all kinds of crazy things in the short term, but in the long term, it will reward the winners in industry. Sometimes it just takes a little longer for the market to realize the winners or accept the winners. And sometimes, and eventually with some companies, say like Amazon and Google, the market doesn't accept it until they start showing profits that are so astronomical that everybody wants to pile in. And that's kind of what I'm investing in. We'll get into that a little more specifically later. You can also invest in dividend stocks, but to me that's also just a protection of wealth against inflation. It can even be a little bit of an income, but that all comes down to at retirement age, once you've already made your money. And that's because dividends on a small scale isn't that profitable. I mean, there's some out there that pay good dividends, but even still, you got to hold a lot of shares to get a little bit of a dividend. And most dividend stocks aren't huge growers. They kind of go up a little if it's still a relevant company, but they kind of go sideways more than anything. So your money's not growing in that aspect. Just every 3 months, you end up getting a little check. Or in my case, if I have some stocks in my portfolio now that do pay dividends, but they're also growth stocks. They're only paying dividends because, well, we'll get into that later. But I have them. It's called DRIP, with dividend reinvestment plan. So it just purchases portions of a share of with however much I get paid in dividends. So if I get $1 on $100 stock, it's going to buy 0.01 of a stock. Is that right? Yeah, 0.01. Which compounds over the years. Over the next 10 years, those little 0.01s really add up, especially when you're also investing in growth stocks. To give you an idea of a dividend stock, Coca-Cola, their stock is $265.58 for one share, and every 3 months it pays you 25 cents per share. No, thank you. No. That's not enough for me. So what do I invest in? I invest in disruptive innovation. And according to Cathie Wood of ARK Invest, the five transformative innovation platforms that could change the way the world works and become the critical productive signposts that future historians identify. Artificial intelligence, robotics, energy storage, DNA sequencing, blockchain technologies are approaching a tipping point as costs drop, unleashing demand across sectors, geographies, and spawning more innovation. That was right off of ARK's website. And obviously you always have to be skeptical of anything, but I've gone down this rabbit hole. She's not blowing smoke. She's not trying to sell you anything. She's right. She's done her research. She shares her research. We'll get to that later though. So let's talk about the mindset of an investor before I break down into different sectors here. I don't trade. I'm not out there buying and selling, trying to catch a 10% jump in a stock and then sell it and then move it into tomorrow's 10% jump and then sell it and then move into tomorrow's 10% jump. It's pretty much impossible. Pretty much. There's some guys that have figured out some ways, and honestly I say guys, but really just I think Timothy Sykes would be the only one, and even that is super complicated, super risky, takes 10 grand because you need a lot of money to leverage to make any money off of small percentage jumps per day. And just as likely as it is to jump up, it will jump down, and then you start questioning, do I sell and just take my loss, which is Timothy Sykes' way of doing things, and it is a smarter way. Take small losses, because most of these stocks that they're jumping in trying to catch these jumps are kind of worthless stocks, and they're investing based on hype as opposed to actual things of a company. They're basing their investments on what's going on forums and what's getting talked about in chat rooms, and they even have their own setup so that the more students he gets, the more they affect the stocks that they're talking about. You can go down that rabbit hole if you want to. I did, and it's super risky. So what I do, I invest. Everything I'm buying, I have every intention of holding until the year 2030. No matter what the stock does, I'm not selling. Now, what the stock does and what the business does are two very different things sometimes. The more you pay attention to the stock market, the more you'll see that. A perfect example is technology stocks, Amazon, Google, Facebook, and now it's Tesla. Tesla, from 2014 when they went public, I think it was 2014 or 2012, don't quote me on that, I don't got it written down here, until 2020, the stock went basically straight sideways. Even though the company was executing all of its plans, all of its milestones that they set, they executed. The only thing they had against them was that their timeline was a little off. They'd say third quarter 2015, and it ended up second quarter 2016, 2017. Yeah, they'd be off by a couple quarters. And when he ramped up the Model 3, which was his first large production car, because he is literally reinventing manufacturing the same as Henry Ford did, and I don't say that lightly, he is literally reinventing manufacturing. There were some growing pains. He had to figure it out. He'd come up with an idea and they'd build it and it would almost work, but there'd be some kind of constraint. There'd be something that didn't quite work or something that would break, because they're literally building these machines from scratch. Nobody makes these machines that he's using. You can't just go buy them in a catalog. But he's got that figured out now. Now he's building factories, from clearing the land to a car coming off the line in 1 year. That was impossible before he did it. But we'll get into that later as well. So I invest for 10 years. No matter what happens to the stock, I'm in it for 10 years. Now if something changes with the company, I'll reassess it, but something would really have to happen for me to reassess. And I don't see that happening, but anything could happen. So we'll just go forward and reassess as we go, but no matter what the stock does, I'm not selling. Now if the company changes, that's a different story. So you just put your money in there and you just leave it. You don't take gains. If it jumps up 50%, you're like, oh, I'm going to take these profits. Why would you take the profits on a company that's going up? What are you going to do with that money now? You're going to go out and spend it? Well, then you're not investing. You're going to put it into a different company that you hope is going to run up like that? Good luck. To me, you've already found that company. Now you just took your money out of it. just leave it there and let it grow. A concept that's kind of easy for the mind to comprehend with compounding is, if you have $100 and you get 1%, that's only, you get $101 the next day. Then if you get, but each day as you leave that money there, even with getting the same percent gains, the amount of dollars you're getting will grow, and over a 10-year time span, it will be astronomical. You will literally be wealthy if you stick to the plan. But we'll keep getting into that later. Because obviously you have to invest in good companies. You just can't just put it anywhere. Biggest risks. All you're going to do is lose your money. Yeah, so don't get discouraged if the stock goes sideways. The plan at that point, if you have conviction and believe in your research and you believe in the company you're investing in, you just keep accumulating. Buy more, buy more, buy more. Get as many shares as you can. The game plan when a stock goes sideways should be to accumulate, to hoard as many shares as you can, because they say the longer a stock goes sideways, the bigger the breakout. That's somebody I listen to has been saying that for a long time. There's videos going back to 2014, well, maybe not quite that far because it hadn't gone sideways yet, but maybe 2016, 2017, 2018. And now she's getting proven right. And that's Kathy Wood. We'll talk about her later. A lot to go over here. So yeah, you just want to keep accumulating. Even if the stock goes down a little bit, if you buy it at $100 and it goes down to $80 and just goes sideways, and $75 and just goes sideways, just keep accumulating. Look at it as discount shopping. Because when it goes up, all those extra shares you bought at a discount price will make you a very wealthy person. I've seen plenty of examples of this, and I'm sure I will see plenty more, including my own portfolio. A little more specifically about stock valuation. Do not equate stock price as a value of a company or the stock. Don't think that a $1 stock is a better buy than a $2,000 stock. It could honestly be argued the opposite. There's a reason that stock is a $2,000 stock. Now that goes back to what I said earlier, don't equate past performance to future gains, but that $1 stock is $1 for a reason. But it's also still more complicated than that, because there is no rule on how many shares of stock you can have in existence. So to value a company in one metric, you take the number of shares available, say 1 billion, and multiply it by the stock price, say $5, you got a $5 billion company. That is a very good sized company. So just because it's only a $5 stock doesn't mean it's a small company. To get market cap, you have to multiply stock price by number of shares in existence. So that gives you what the market values a company at in a dollar amount. But then some people also consider the PE ratio, which is the price to earnings ratio. So how much, and only companies that are posting profits have a PE ratio. So if they're posting losses, you can't use this metric. A PE ratio doesn't exist. So you'll get multiples. So you can people use that to compare industries. So like, if say you're comparing the auto industry and Ford has a PE ratio of 25%. So their earnings is 25% the price of the stock. And GM has a 20% PE ratio. Now, if you look at those two companies and you think they're equally valued in my book, but GM is trading at 5% lower PE ratio than Ford, so that might be a better buy because you see 5% upside to it. But likewise, if you see a company that's trading really high PE ratio in an industry, then you might think it's overvalued and you might think I should sell this stock and wait for it to drop. But that also goes back to being a trader instead of an investor. And it also doesn't take into account innovation. And what I mean by innovation is a company that is reinvesting in itself is taking its profits and putting it into R&D and into building out factories and into whatever else. They're reinvesting in themselves, which directly lowers their profits. So a perfect example now in hindsight is Amazon. He started in the 90s as an online bookstore and then kept reinvesting in himself. Every little bit he got, he reinvested in himself, and their PE ratio was astronomical. But that's because he was taking all these profits and putting it back in the company, so he wasn't showing any profits. And the people that knew what was going on were willing to pay very high amounts for that stock, even as the company posted losses or very slim profits. Because once Amazon got to a state where it had so many fingers and so many pies, it was like it turned on a money printing machine, and the PE ratio immediately dropped to such a point where everybody wanted in on it. They finally saw that it wasn't overvalued based on PE ratio the whole time. It was just the way the numbers worked out with reinvestment. PE ratio does not take innovation into account, and a highly innovative company that invests heavily in itself is going to show less profits in the earlier stages of their development. And those are the companies that I am trying to invest in, is these companies that are reinvesting in themselves. And that's also where this 10-year time window comes in. It gives them a chance to mature. And I'm not saying I'm going to sell it 10 years, but that's just at least when I'll reassess it. Maybe I can retire by then. And I'll want to turn my investments, which stay there and compound, into earnings that I can live off of without having to sell any stock. So I said don't equate past performance to future gains. That's like the old industries are being disrupted, so new industries mature at an S-curve adoption rate. So I'm going to put some charts up here. The S-curve adoption rate is graphed on a board based on, let me read the definition here. The rate at which the population adopts a new technology. Think of CD players, DVD players, cell phones, Facebook, Netflix. Start slow, then everybody buys the product, and then it levels out. So it starts slow, everybody buys the product, and it levels out. This is everything in the last 100 years for technology, basically. I mean, refrigerators, microwaves, cell phones, TVs, cars, telephones. I can't remember what else is on there right now. I don't have the chart in front of me. But these are actual numbers. So the old industries being disrupted are physical bank branches, brick and mortar retail, linear TV, freight and rail, and traditional transportation. Linear TV is, think cable. When we were kids, or at least most people my age, you had to flip through channels and you could only watch what was playing at that time. And if you were lucky, you had a TV guide on your TV that you could flip through the different channels to see what was on, or you had to flip to a certain channel and the TV guide was constantly on scroll, so you just had to watch that channel for a minute or two while it went through all the channels. And you also couldn't go forward more than you could only see the next 2 hours worth of TV. So basically that's already gone, but I mean, that's of all these, that's one that's literally already been disrupted and continually. Disney just opened its own service. You got Amazon Prime. Speaking of Amazon, you've got Netflix, you've got Hulu, you've got Crackle, you've got Tubi, you've got Roku, freight and rail. Living in Houston, there's a lot of trains around here. We've got a huge port. We've got a lot of oil refineries. We've got a lot of use for rail. And maybe localized rail systems like this might stay in use. But long distance, autonomous semi-trucks, driverless semi-trucks will be doing it. Electric driverless semi-trucks. The cost per mile will be so much lower than even freight and rail, which is confined to tracks, that it won't make fiscal sense. Traditional transportation, that's you and me buying a car. That sounds ridiculous, but within 5 years, I would say in major cities, people won't be buying cars anymore. It'll be people whose cars are dying will be getting on subscription-based car services, just like you pay for Netflix every month. And you'll have an app on your phone, and you want to go somewhere, you'll just push a button and one will pop in front of your house within a couple minutes. There's going to be so many of them around. There won't be a lag time. It sounds crazy, but when people do the math on cost of ownership and also the amount of time that your car is not in use. Where are you going? The amount of time your car is not in use, it will take far less cars to service the population, which will also lower traffic. Things will drive more efficiently. They can drive faster when people aren't driving. I think it'll get to the rural areas, even small towns with a couple hundred people, within 10 years. Same thing, it sounds crazy, but within 10 years we'll be producing so many of those taxis, they'll just be on the road. I mean, think of semi-trucks driving cars from the factory to the dealerships. You take a semi-truck and you put 6 cars on the back of it and you drive it that way over tons and tons and tons of those semi-trucks. Every 6 cars needs a semi-truck. Imagine when it can roll off the line and then drive itself to wherever it needs to go. That's kind of mind-blowing. No cars, no nothing. Not even a program. It's autonomous. It has a brain. It sees you put in where it's going and it goes there. It doesn't need you to map it out for it. It can map it for itself. It can make left turns on a green light, and it'll stop on a red light, and it'll yield for pedestrians, and there's even a video on YouTube where a Tesla notices there's 3 cars in front of it on a highway, and they're going 60 miles an hour maybe. The one car in front of it is driving normal. The car in front of that is driving way too quickly and about to rear end the 3rd car in front of it. And the Tesla actually slows down before the accident happens. It intuitively slowed down before the accident happened. It's crazy. I'll try to find it and put a link up link in the description. And physical banks, I mean, everybody's going online. Cash App, Venmo, PayPal, Square. Money's digital. You don't need paper money anymore. You don't need a bank vault. It's all digital. It's all code. When your boss gives you a piece of paper check, you never get that cash in your hand. You go to the bank and they digitally punch in how much money you have, and it draws it from your boss's bank and into yours. There's no actual cash changing hands. It's all digital. So why do we need these big banks? Why do you need to pay all these people to sit around in there waiting for you? Why do you need to pay the mortgage on it? If the banks own it, it is property, but at the same time, a bank is not invested in that property in itself. It is a business, and if the business doesn't make sense, yes, you can make money off the property, but it becomes a liability. Same as the traditional automakers that make gas-powered engines trying to switch to electrification. They buy all this equipment to make gas-powered cars, and now they have to scrap all that and start from scratch to make electric cars. And the engineers that are engineers of gas cars are not engineers of electric cars. It's completely different industries. Just because they have four wheels and doors doesn't make them the same thing. And when it comes to robo-taxis, they're not even going to have a steering wheel anymore. So traditional transportation is getting disrupted. Any old industries won't necessarily be able to adapt as well as you would think a multi-billion-dollar conglomerate would be able to. And that's because most of them are like ostriches. For the last 10 years, while all these technology companies were screaming past, coming up and catching up, and now long past them, they were like ostriches with their head in the sand, acting as if it's not happening. And now they're trying to play catch up. They're finally getting apps that are decent. So be careful of the old industries. There's a good report. I'll put the link in it below. It's called the Bad Ideas Report by ARK Invest. It's a 20-page research report on declining cost curves of disruptive innovation compared to current technologies. Think of Kodak film before digital. Like everything, Kodak was the movie film. Kodak was the 35 millimeter film. There was no alternative. Obviously there was other brands, but I mean Kodak was the brand. And then digital came along, and within a blink of an eye, their whole film industry deteriorated. Imagine all that equipment, all that investment, all those engineers and employees out there making film, and then within a blink of an eye, it's all torn down. That's happening to all these industries, and this report is very informative. Not just speculative, actual declining cost curves and S-curve adoption rates and graphs and actual research and proof. This isn't guessing. So where do I have my money? It's in disruptive innovation, which I've mentioned, but what that entails: autonomous technology and robots, genomic revolution, next generation internet, financial technologies or fintech innovations, mobility as a service, that's robotaxis, 3D printing, Israeli innovation. I know that sounds weird, I'll get to that in a little bit. And cryptocurrencies, but that's Bitcoin. So what is a declining cost curve? That is based on Wright's law. I'll put the equation up here. It's y equals ax b I don't know how you say that. I'm not a mathematician, but I do understand it. So Y equals the cumulative average time or cost per unit. How long it takes you to make that unit. How much it costs you to make that unit. That's what this is going to equal. A equals the time or cost required to produce the first unit. X is the cumulative numbers of units produced. So that's the more units you've produced, as long this only applies to innovation. Only innovation follows this declining cost curve. So the more units you produce, the cheaper it's going to cost you, and the more efficiently, the quicker you're going to be able to make them. And B is the slope, so that's the decline, the S-curve adoption rate. The quicker that people adopt it, the quicker you're going to see these declining cost curves. This first one is more specific to Tesla, my thesis on Tesla. It's exponential growth. It occurs when the instantaneous rate of change of the quantity with respect to the time is proportional to the quantity itself, which means it's a doubling of a doubling of a doubling of a doubling. So put that in perspective, and it's very hard to put into perspective. Our human brains have a tough time comprehending exponential growth. I'll put it up on the screen here so you can see it. So the best example to give is steps. So if you take 30 linear steps, each step is 1 foot. In 30 linear steps, you will be 30 feet away from where you started. In 30 exponential steps, that's the first step is 1 foot, the second step is 2 feet, so that's 3 feet you've traveled. The fourth step is 4 feet, so that's 7 feet you traveled. The fifth step is 8 feet, then 16 feet, and so on. By 30 steps, your 30th step will be 536,870,912 feet. Just that one step. That's not how far you will be. That last step will be that large of a step. And where that applies, and that seems crazy, it sounds impossible, but it has been proven throughout history of innovation and technology ramping up that it is more than possible. And Tesla is actually doing that right now. They have been growing exponentially for about the last 6 years. This year, or I should say 2020, they just posted 500,000 units produced and delivered. In 2021, I'm estimating they're going to produce 1 million, and so on and so forth. And how that's possible is because they are putting up factories so quickly and expanding their factories so quickly that their rate of growth is going to double their production year after year after year. At this very moment, they have just producing cars. They have many aspects of the business. We'll get into that later. Just producing cars, they have a factory in Fremont, California, and one in Shanghai, China. That's where they produced 500,000 cars. They just started out of, and they're expanding both factories. So they've already got 2 that they're expanding. Plus, they're also building one in Germany that will come online this year, and one in Austin, Texas that will come online this year. And those won't necessarily produce that many cars this year, so that will add to this year's to get them with the first 2 factories running and even expanding their capacity. That's going to push it up from 500,000, and then the little bit that they're going to get out of these other 2 factories will push it to 1 million. But then next year, when these 2 new factories ramp up even larger, that's going to help double it. Along with, I guarantee, another factory starts getting built, if not this year, in 2022, and maybe even multiple. I see Western Europe, maybe England or France, somewhere in that side of Europe, making another factory. I see maybe, well, I think Indonesia is going to be getting one, which will kind of put them closer to India and also Australia. So they are growing exponentially right now. And some people might say that the price is really high, but this goes back to the example of Amazon. It's not high, and it's still going to go up. There's nothing bringing this stock back down. If this stock drops at all, I'm buying. If it drops 10%, I'm a buyer, let alone if something happens like a second wave of COVID and it drops 60%. If it drops 60%, I'm selling every one of my other stocks and putting it all into Tesla. But I don't see that happening. But I don't see it coming back down. There's too many catalysts. And like I said earlier about him messing up timelines, he was always overestimating how quickly he could get something done. Now he's learned, and the stock market used to punish him for that. Now he underestimates how quickly he can get it done. So then when he delivers ahead of schedule, the stock market rewards him for it. It sounds so stupid and superficial, because to me the man is delivering on his promises, because most of his promises are innovation that was thought to be impossible. So if he's off by a little bit of timeline, I can forgive him for that, as long as he continues to innovate. So yeah, Tesla's my number one holding, and no matter what happens, I'm not selling it. A little more in depth, but very quick, because there's hundreds of hours of material I've been through in the last 5 years, going back to last 5 years on Elon, and actually even further. 2006, when Elon first took over Tesla, he released a report called the Secret Tesla Motors Master Plan, and then in quotation marks, just between you and me, because he's really funny. He's kind of a troll to mainstream media and Wall Street analysts, because they don't quite understand, and they doubt him, and then he fucking proves them right. And he's not even cocky. He just does it real subtly. He's like, I don't need your approval from those people. He just does his thing and innovates, and he just does his thing. So in this master plan, he laid out how, starting in 2006, Tesla would build a Roadster. So that Roadster was based on the Lotus Elise. He took their body and chassis and packed a whole bunch of laptop batteries in it, made the very first all-electric, well, not the very first. He made the best all-electric car up to that point. But it had a lot of drawbacks. But because it was a bit of a novelty, he charged a lot of money for it. And that was in this master plan. Build a car, charge a lot of money for it. Once he raised enough money doing that, he expanded it to the S-type, or the Model S, which is a sedan in the same price range as like an S-Class Mercedes or a 7 Series BMW or a A8 Audi. And then when he sold that to richer business people. He lowered the price or came out with another model that was lower, and he's going to continue. He's doing the Henry Ford model of lowering the price as the declining cost curve affords him the opportunity to, so he can bring in more people. His goal is to transition the world to sustainable energies. He's not a car company. He is an energy company. Just happened that he started with cars. It was where he could infiltrate the market the easiest from his perspective. And obviously his perspective was right, because now he is absolutely crushing it. Tesla has sold every single car it has ever produced. So if you hear somebody saying sales are down in England, or sales are down in this country, or sales are down over here, they lost shares in this area, it doesn't matter what shares they lost in different places. That happens because he literally is not producing enough cars to supply the demand. So, and he's not going to send one car to England, and one car to Germany, and one car to Australia, and one car to China. He's going to say he's got 100 cars to ship to England. He's going to produce those 100 cars, ship them to England, and then he's going to produce 100 cars and ship them to Austria, and then he's going to build 100 cars and ship them to wherever else. So it's very staggered on his percentages in certain locales, but the only number that matters is total deliveries. He is selling every car he can produce, and that's why he's expanding at exponential rates. He needs to produce more cars before he can supply all countries equally. So if you hear somebody harping on about he's losing market share in a certain location, good luck to listening to them. Somebody like Gordon Johnson, or like, good luck, he's an idiot. But that's a whole nother subject. I won't even go into that. To be honest, I wonder if it's even his real thoughts, or if somebody's paying him, say like an oil company. But that's a whole conspiracy theory rabbit hole we won't go down, even though it's probably right. So yeah, hint about that master plan. He has executed it perfectly. Everything he's said, he's executed. As far as I know, the only thing I've noticed in there that didn't get executed, and that's not because they didn't try to, it's that nobody wanted it once he did, even though it might come back later. The technology just wasn't there, and that is vehicle to grid technology, where you can plug your car into your house to charge your car, but then you can also reverse it and use your car to power your house. And he did have that. He said when it was in the cars, nobody was using it. But that's not to say it won't come back. Tesla is also a solar company and energy storage. Even more importantly than solar is energy storage. They make batteries, very energy dense batteries for the cheapest price. They make the most energy dense batteries for the cheapest price. Now think about that very literally. And they're still innovating. They have a new battery plant of their own battery design, technology, manufacturing technique being built in Fremont, Germany, and Austin as we speak. So they're only accelerating their lead. When you hear about GM or Ford or any of these guys coming into the market, trust me, they're nowhere even close. Ford is still going to put a gas-powered engine in its truck to help people with range anxiety, which is unnecessary from everything I've ever heard about Teslas. I mean, there's literally people that take cross-country road trips. There was a record set by a Tesla for the Cannonball Run, which is how quickly you can drive from one side of the country to the other. And So that just goes to show, like, on a time basis, it can be done. But on the energy storage side of things, there's a couple things with this. So one, for the consumer like you and me, and then if you own a house, you can buy the Tesla Powerwall, which is a battery pack that will power your house. So they've also created this software called Auto Bidder software, where your Tesla Powerwall, the battery pack, will buy electricity from the grid. Now this is assuming you don't have solar panels on your roof or not enough solar panels to fill it. Your battery pack will power itself from the grid at nighttime when demand is low and prices are cheap. And then when demand is high and prices are high, it will sell it back to the grid, literally making you money without you having to do anything other than buy this Tesla Powerwall. I believe it's going for about $7,000 right now with installation, which to me is cheap when you think it's powering your house. If there's a blackout, you're not susceptible to that. Auto Bidder software makes you money by buying this power pack. They also help to stabilize the grid. So I didn't know about peaker power plants until I went down this rabbit hole. And what a peaker power plant is, for those that don't know, we have our standard power plants. They're running, whether it's hydro or coal, but they don't store any electricity. When they make the power, it gets in the power lines, we use it up. If we don't use it up, it gets used up somewhere. It just keeps pumping into the system. So there's no storage. So in high demand times, these peaker power plants have to fire up and produce even more electricity and more pollution. In Australia, there's a project called the Hornsdale Power Reserve. I say a project, but it's already done. It's been running for years now. It's in South Australia in the desert, where they were constantly having blackouts because of too much power consumption. And Tesla went out there and built, I can't remember what they call it now, but it's basically tons and tons and tons of these power walls all put into an outdoor system. They're just a big old battery out in the middle of the desert, and it runs on Auto Bidder software. So in the middle of the night, when the demand is low and the price is also low, it fills up, and then during peak hours, it empties out its batteries onto the grid. And since this project has started, they have South Australia has never turned on one of their peaker power plants. So that's the kind of impact it can have. And this was just a test, a pilot project. Imagine when that's around the world. And then imagine when those are coupled with renewable energies. Actually, in the United States, we just passed a milestone in December of 2020 where we are now using more renewable energies for electricity than we are for coal. So that's very good news for the environment. And if you haven't looked into Tesla's solar roofs, it's absolutely phenomenal. They've had some growing pains, but like I said, he's an innovator. He comes into these problems and then he comes up with solutions. I mean, nobody ever invented something without trial and error. I promise you that. The history books might not talk about it that much, but there is years and years and years of trial and error. And now we're already passing that with Tesla and their solar. They're really starting to figure it out. Actually, today the news came out that they are delivering their own power inverters for the Tesla Powerwall, where before they were buying it from a supplier. Which I didn't mention about Tesla is they are vertically integrated, which means they bring in raw materials and then produce the parts, which makes them a lot less susceptible to supply chain issues. And it also makes them much more profitable. They don't have to share their profits with hundreds of suppliers. Companies like General Motors and Ford and Fiat and Honda and Mazda, these are all catalog car companies. They might say Honda or Ford on these parts, but they don't produce those. 90% of the parts on these vehicles come from a supplier. They open up a catalog and pick out parts. The only thing that they produce is design. They are literally design firms and building. They put them all together, put all the parts together. Where Tesla even has its own seat factory. Gigacasters, but we won't get into that right now. Google it if you want to know what a gigacasting machine is. It's a one of a kind. Tesla had to literally build the machine themselves. But with the Tesla Solar, they now just passed an inflection point where it's said that it is cheaper to have a Tesla solar roof. And now this is not solar panels on your roof. Tesla makes solar panels on the roof. You can have it over your top of your existing roof. But now they actually make a solar roof, which you can have in all different styles. They have terracotta looking roofs, they have slate looking roofs. They're absolutely beautiful. And they're indestructible. They take sledgehammers to them. He literally wanted to warranty them for an infinite warranty on it. And his legal department said they can't really do that. So basically he said, the roof is guaranteed until your house falls down. And I know some people back in Minnesota that had a house that was 150 years old. So just saying, then the house was still in good condition. So it's a very sturdy product. And it's beautiful. And it's said to be cheaper than the price of installing a standard shingle roof. So imagine that. You can get a roof for cheaper installed that will produce you power. You will no longer be susceptible to the power grid, to power outage, to power bills, to the amount you consume. And you can even make money with auto bidder software and your Tesla battery. You put a couple extra Tesla batteries and supply the grid. And as more and more people adopt this, the less and less power plants we're going to need, until the point where we no longer need power plants, or at least very, very minimal. And those will be wind and solar, because we will need so minimal, we won't need coal or any of those. All right, so next up, let's talk about ETFs. Okay, ETFs is exchange traded fund, which is what Cathie Wood of ARK Invest offers based on their research. And basically what that means is it's sold on the stock market, same as a stock is, except that it is actually a group of stocks. It can be any number of them. Some of hers have excess of 50 stocks in them. But all of it is done based on research. There is no guesswork here. They actually do the legwork. They actually see the factories. They speak with the CEOs. They speak with the engineers. They speak with the doctors. They see actual real-world results and growth. And sorry if you hear a plane over top. We'll probably hear a few of those. I'm just going to keep on talking right through them. It's kind of like a mutual fund, but quite kind of different. Mutual funds are traded differently, or bought and sold differently. ETFs are bought and sold just like a stock. They're actually about to, ARK Invest is about to release a new report coming up very soon. Actually, I think it might have come out yesterday, where Cathie Wood and her analysts will sit around and talk about their latest research reports. There are management fees associated with ETFs, but they're so inconsequential compared to the services rendered. I'd say good luck finding better value for your money. So I really don't worry about ARK Invest's management fees. Maybe somebody else's if they don't have the performance, but ARK Invest has the performance. So what they offer right now, they offer 7 choices, and there's actually an 8th choice coming very soon, which I am excited for. I'll talk about that one last. It's not even in here because it just got announced. The first one is ARKK, ARKK, which comprises all innovation, which basically it means after this one, I'm going to go through some of their ETFs, and the other ETFs are much more specialized, where this ARKK is a combination of these other portfolios, these other ETFs. Some of the stocks in that are Tesla, Roku, Square, CRISPR, Zillow, PayPal, Spotify, Twilio, Baidu, and Invite. Next one is ARKQ, which is autonomous technology and robotics, which gives you exposure to autonomous vehicles, energy storage, robotics, automation, 3D printing, and space exploration. Yeah, robotics are coming. Robotics are coming real quickly. I'll put a link in the description down below of what Boston Dynamics is doing. If you haven't seen their YouTube videos, it's absolutely crazy. There's a robot running through a snowy wooded area. There's robots dancing, and I mean really dancing. The dexterity and the movement is phenomenal. Amongst this portfolio, surprisingly, well, I guess not really surprisingly when I thought about it, at the number 4 position for weight in the portfolio is John Deere. I haven't gone down that rabbit hole yet. Maybe some of my friends on farms know a little more about it, but I assume you're not going to be sitting in that cab anymore. You're going to send your tractor out there and it's going to plow the fields for you. It's going to do all the work for you. Well, obviously not all the work. Farming is not an easy job. I know that, but you won't be sitting in a tractor. And autonomous vehicles, that's robo-taxis. And to me, Tesla has that one. If you haven't seen their videos on YouTube of people with cars that they have a beta program out for certain people, it's pretty crazy what these cars can do. I mean, think of a big intersection at a 4-way stoplight with 2 turn lanes going left. These Teslas know how to get in that turn lane and make a left from the turn lane when the stoplight turns green. They go about roundabouts and exit at the correct spot. It's crazy. I already talked about the accident prevention. So autonomous driving is coming, and to me, Tesla is the winner. But I could be wrong. There are some other companies out there, but I think maybe the number 2 position will probably go to Intel, only because they seem to be the only other company that aren't relying on LiDAR. They said they will use LiDAR in production vehicles in the future. Tesla, I think, has still got it won because the sheer amount of data that they have and the sheer amount of mapping it out, and now that it's AI, it learns at an exponential rate, and the more cars Tesla produces, the quicker it learns. And every new instance, every new situation is analyzed and learned from by the computer, which is called, I believe, Titus, but I could be wrong. Don't quote me on that. The next ETF, ARKW. That's next generation, which gives you next generation internet, which gives you exposure to artificial intelligence, big data, cloud computing, cybersecurity, and blockchain technology. Artificial intelligence, that's Tesla's computer being able to learn for itself at this point. Big data, that's Tesla's computer collecting literal billions of miles of driving. If you don't believe that number, Google it. Maybe I'll even put up the actual number now. I believe there's a counter on the website, at least there used to be, for how many billions of miles Teslas have driven, and that's data collected. Cloud computing, that is, say you have a crappy computer but you want to do video editing. Amazon offers a service, AWS, Amazon Web Services, where basically your crappy computer connects to their supercomputers and you can do all this video editing through their good computers, and basically all you're doing is accessing the internet. And that comes with a lot of different things. It doesn't just have to be video editing. It could be accounting. It could be anything. It could be anything. So, and then blockchain technology, that is Bitcoin, cryptocurrencies. Blockchain, what that means is, I won't go too in depth, but basically every transaction that ever happened on Bitcoin ever has been written down. It's just a list. Imagine I sent money to Bob. Bob sent money to Katie. Katie sent money to and it just keeps adding on to that list. Every time money is transferred billions and billions of times, it just keeps adding to that list, and you can scroll all the way back to day one of Bitcoin and see. Now it doesn't say Bob and Joe. It's based on cryptography. There's certain numbers that identify me as me. It doesn't tell anybody who I am, or where I'm at, or anything like that, or what computer I'm using. It has none of that information. It only has my wallet number on it, basically. The next ETF is ARKG, which is Genomic Revolution, which gives you exposure to CRISPR, gene editing, therapeutics, agricultural biology, and healthcare innovation. This is my second largest holding, second only to Tesla. Genome genomic DNA sequencing is coming to a point where it's following the declining cost curve, and right now it will cost you and I less than $1,000 to go get our DNA sequenced, which has a lot of health implications with early cancer detection and other genetic diseases. I was even reading that it can help with with people who have heart attacks, with coronary heart disease. There's actually two instances. There's an instance with a mouse and with a primate that were born blind, and they were given sight through DNA gene editing. And that's coming very, very quickly. It's already happening. Now it's just a matter of the declining cost curve, which opens it up to more customers, which declines the cost more, and it's a snowballing effect. So I want to be in before that snowball really starts rolling. Once that snowball gets rolling, not to say it's too late, but you've missed the lion's share of the growth. Next one is ARKF, which is FinTech Innovations, or Financial Technology. That gives you exposure to mobile payments, digital wallets, peer-to-peer lending, blockchain technologies, and risk transformation. Mobile payments, that's like, anything. Mobile payments, you can buy stuff on Amazon with the click of a button. I can send money to a friend with PayPal or with Cash App or Venmo. Digital wallets, that's literally a digital wallet, like I was saying earlier with banks and money. It's all just digital. You keep all your cryptocurrency in a digital wallet, but you also keep your money from Cash App and Venmo in a digital wallet. Peer-to-peer lending, that I'm actually getting 6% interest on my Bitcoin. Now compare that to your bank. I didn't misspeak there. 6%. I want to say banks are at like 0.02 or 0.02% interest, something pathetic. Why would you even save money in an account that gives you that when I can get 6%? You can even get 8.6%. So I'll put a link in below to Blockfi. Click on that. You'll get $10 free in Bitcoin. I think I get a couple free dollars in Bitcoin. There's also one for Coinbase. I'll put a link below. Same thing. We get a little free money out of it. Both of us will. Blockfi is the savings account. Coinbase is the platform to purchase the cryptocurrencies. And there are small fees associated with buying, selling, and transferring cryptocurrencies, but kind of like the management fees from Cathie Wood and ARK Invest, they're so inconsequential, they're so small compared to the gains that I don't worry about the fees. Now, obviously, I'm not just moving it around. I'm not just buying it, selling it, buying it, selling it. That would get expensive. But let's say Bitcoin. Say I want to buy $100 in Bitcoin. It's going to have, say, a $2 fee. So now you have $98 worth of Bitcoin. And then you'd go to your Bitcoin wallet, which is right below where you bought it, and say transfer. You can say buy, sell, or transfer. You say transfer. And that will give you a unique wallet ID. You take that wallet ID over to Blockfi and put transfer on Blockfi. It'll say where from, or receive. And you go to Blockfi and hit receive, and we'll ask for the wallet. You put your wallet in there, just cut and paste. It takes a couple minutes, and boom, there might be another $2 fee. So now you only have $96 in Bitcoin, but now you're making 6% interest on that plus the growth. I started investing in Bitcoin back in about July at $9,000. Now it's upwards of like $36,000. And honestly, I think by 2030 it will be close to $1 million. That's not an exaggeration. I think by 2025 we'll be at about $200,000. And I think once it hits that, I think it's already opened the floodgates, but at that point, even the skeptics nowadays, which I bet most of the people that are listening to this are Bitcoin skeptics, go ahead, be a skeptic, get left behind. I'll get into a little more specifics on that later, but definitely click on the links below. Coinbase to buy it, Blockfi to save it. I started with like 3% of my portfolio in Bitcoin, and now it's over 10% with the growth and the interest. I think since July I've gotten about $20 worth of interest off of what I invested of about $600. So, I mean, that's a lot better than, plus it's grown. Now off of $600, I'm at about $2,000, which means that 6% interest is going to grow exponentially with my growth in Bitcoin. I'll get into that a little more depth later, so that peer-to-peer lending, that how I get such a high interest is because I leave my Bitcoin in there. People can borrow US dollars based on their Bitcoin collateral. So you have $1,000 in Bitcoin, they'll loan you, say, $500 in US dollars. And obviously, if Bitcoin starts to crash, they can liquidate your Bitcoin and get their $500 US dollars back, whatever it is. And that's the risk you're taking, getting a loan based on your Bitcoin. But that also means you get to keep your Bitcoin. And while US dollars are becoming less valuable in the long run, which I'll get into that later, Bitcoin is appreciating in value. So that's why somebody would want to borrow based on their Bitcoin, and that is how I get paid high interest based on me saving my Bitcoin. And there's so little overhead in a digital banking system compared to a traditional that they can pay me those rates. The next ETF is PRNT. That's 3D printing, and ARK believes 3D printing is one of the highest growth potential industries in the economy, and it's set to transform the manufacturing landscape. I don't actually hold this in my portfolio. I do own all the other ones. But I do own a 3D printing stock. It's Desktop Metals. It's from another person I'll talk about a little later, Chamath Palihapitiya. Basically with 3D printing, and more specifically the Desktop Metal one that I hold, you can 3D print metal in an office without ventilation. And that's print it, cure it, harden it, all in an office without ventilation and without shrinkage. And that was a big deal before, is the shrinkage. You would print a part, and then it would, by the time it was finished product, it would be smaller than you intended. And Desktop Metals has gotten that figured out with their own innovative technology. But I probably will invest in PRNT, not through their research, but through my own. I believe that we will be 3D printing houses within 20 years. Maybe within 10. I think within 10 years we'll start seeing buildings being printed, and within 20 years we will be mass printing houses. That seems crazy, but it's not. It'll be so efficient. It'll take so few people. It can pretty much run 24 hours a day, very silently. But that's a whole nother thing. We won't get into that right now. The next ETF is IZRL, which is Israeli Innovative Technology. I won't go too deep into this. I do own a couple shares of it, just because prior to even knowing about this ETF, I had watched a documentary on Netflix, and I can't even remember what it was about exactly, but it took place in Israel, and it was about innovation. But I don't know how I ever got onto it to begin with. It was just something that I was curious about. And basically, they were speculating on why Israelis are so innovative, and it's because they're inclined to tell their superiors no when they think that something is being done illogically. And they won't get fired for it. It's not like in America where your boss has an ego. It's like, do this because I said, and do it my way because I said, and that's it. And if you say no, your boss is like, all right, you're fired. Go. Bye. Insubordination. Where in Israel, or Israelis are more likely to be open-minded to the suggestion of improving something, as opposed to being stuck in their ways and having an ego about it. And that spurs innovation in a very big way. It takes out all the stops that egos put in. So I am invested in that. The last ETF, which doesn't exist yet but is coming, is ARKX, and that is space exploration, which is drones. I put it in my thesis that I posted on Facebook. I will also put a description of it up here because I don't have it in my handwritten notes. But yeah, space exploration, that's a very exciting field to me. I believe we'll be on Mars. There'll be people on Mars before the decade is out, maybe before even half the decade is out. Yeah, so that's all for her ETFs. I'll talk a little bit more about cryptocurrencies, or really more specifically Bitcoin. Before I get too deep into it, I would say Ethereum is probably the only other one that I actually have confidence in as far as value goes. And there's literally thousands of cryptocurrencies. And if you want to go speculating and throwing your money wherever you want, go on ahead. That's not what I'm doing. That's not what my investment thesis is about. That's not how you build wealth and compound it. Now you're just gambling. You might as well go to the casino and play roulette. So Bitcoin is what I invest in. I did have some Ethereum, but my conviction going down the rabbit hole is much more on Bitcoin. Ethereum to me seems like more of a platform which has a lot of value, but Bitcoin gets its derives its value from many different aspects. One of them is a store of wealth like gold. Now that might seem absolutely insane to somebody who hasn't gone down that rabbit hole, but not only is it logical, it's far more logical than having gold. And the older you are, the less likely you'll probably comprehend it without forcing yourself down that rabbit hole. Because people nowadays are much more digitally inclined. They don't necessarily want the physical gold anyways. You can't go spend it. You take it to a pawn shop, they're going to try to rip you off. If our economy broke down and you had to go spend gold, that puts you in quite a danger of somebody trying to rob you. I mean, imagine trying to carry enough gold to go spend it on something. You're going to be clinging them around in your pockets. Nobody wants to carry that. Where Bitcoin is much more secure. It's based on cryptography. It's decentralized, which means nobody has control of it. It is spread out on so many computers, and it's verified. It verifies itself across all the computers, and that's how it ensures that it cannot be attacked, because there is so much computing power based on the grouping of these computers worldwide. And by grouping, I mean you could even put your computer on it. You wouldn't be able to compete with the amount of computing power that people use to verify Bitcoin. That as soon as somebody would try to hack it or to create extra Bitcoin, that the system would catch it and it would destroy that blockchain. And the blockchain is what is the store of the wealth. The amount of money you have in Bitcoin is written on that blockchain. And if somebody creates a false blockchain, the rest of the systems will verify that it's a false blockchain and it'll destroy it. It's deflationary as opposed to inflationary. And what that means is that as time goes on, you can buy more goods with less of it. So let's say I bought an entire Bitcoin when I first started investing, which I didn't. I didn't even get very much. Like I said, I got like $600 all in at this point. But let's say back when Bitcoin was $9,000, I bought one Bitcoin for $9,000. That would buy me the absolute cheapest Ford Fiesta with roll-down windows. Now, that same Bitcoin 6 months later would buy me, well, it's about $36,000 of maybe a low-end BMW 3 Series or a very high-end, say a pretty good Ford Mustang, lower-end pickup truck, from the absolute cheapest car to a very respectable car. And that's deflation, where US dollars are inflationary. And that means that your dollar is getting devalued with every day. 30% of all US dollars in existence were created last year. And now with the Biden administration, he's about to create even more, which is devaluing your dollar. That loaf of bread that used to cost you $1 will now cost you $1.50 or $2. And that only compiles. If the minimum wage goes up to $15 an hour, that means I have to raise the price that I charge for my food because I have to pay all my cooks that much more. The US dollar will be worth less. That's inflation. And so right now, if my US dollars from my paycheck are not slated for bills or living expenses, gas, food, a little bit of entertainment, beer, you know, how much I figure I need to spend on living, I put directly, well, I first put into my investment accounts. I have that back to the mindset of an investor. I know that was quite a while ago, but set up an investment plan where every paycheck you put a certain amount in there. And for me now, I actually try to be cash poor. So once I put it into my investment account, I plan on not ever touching it. So sometimes I get to the end of my pay period and I'm like living paycheck to paycheck like I'm 20, 25 years old again. But if I really needed to, I could get my hands on that money. I just don't want to. I try to force myself to be cash poor, because when I have to make that decision of, do I want this or am I out of money? Or am I going to sell this stock just to buy that? It makes you reconsider. So my investment plan is always putting in a set percentage of every single paycheck into my investment account. And then on top of that, if there's any extra cash, I store it in Bitcoin. And that is my more accessible. I would be more inclined to pull out my Bitcoin just because I see it. I view that as my US dollars. I just hold it in Bitcoin because it appreciates instead of depreciates. If I was trying to be super safe and I just held my US dollars in US dollars, I'm getting devalued every single day. Granted, I could go to the bank and I could go to the store and swipe my card and buy whatever I want instantly. Yes, that's convenient, but is it convenient to be worth less and less every day? I'd rather store my more accessible cash in Bitcoin, and then if I really do need it, I can just draw a little bit out of there. So that's my theory of Bitcoin with savings and my extra cash. Also, it is a scarce asset. That means no more than what is dictated by the algorithm can ever be created. Right now, there's 19 million Bitcoin in existence. There will only ever be 21 million Bitcoin in existence. And that last Bitcoin will be created in 2140. And the way that works, that might seem like some crazy math, like how did 19 million get created in the last 8 years, but it's going to take another 120 years to create the next 2 million. And that's because of the algorithm. And an algorithm is not a math equation. It is a set of instructions. And a set of instructions dictates that every 4 years, relatively every 4 years, that's not quite the math equation, but that's relatively how it equates out. Every 4 years, the quantity of Bitcoin created is cut in half. I believe right now, every day 900 are created. So then in 4 years, and the halving just happened last year in like July or March, April, something like that, sometime last year. So in another 3 years, that number is going to get cut in half so it's only going to be 450 created every day. And then 4 years from then, it's only going to be 225, and so on and so forth until the year 2140, the 21 millionth Bitcoin will be created. So that's a scarce asset. So the more people that want to buy into Bitcoin, the tighter the supply is. And if you're thinking like there's only 19 million, there's more than 19 million people alive. There's one Bitcoin is equal to 100 million Satoshis. So think of Satoshis like a penny. For every one Bitcoin, you can have 100 million Satoshis. And to give you some perspective on what that's worth today, it would take 30 Satoshis to equal 1 penny worth of Bitcoin. And I mean, a penny, even in today's standards, is pretty much worthless. So you can really break Bitcoin down really far and still be able to spend it very easily. Oh, one other thing I didn't talk about when it comes to about investment accounts. A Roth IRA, if you don't know what that is, it's a retirement account. So once you put money in there, you cannot withdraw it, but your gains are 100% tax-free. Now think about that. Like, for me, that's another 25 years until I can withdraw that. That's a long time. And all the gains in those years will be tax-free gains. To give you a little more perspective, I only opened mine last year. And you can only put $6,000 per year in it. So I maxed mine out last year. And now it's almost worth $13,000. So that's over a doubling in 1 year. Now if I double it again, on top of adding another 6,000, that's 6,000 on 13,000, that's 19,000. Doubling, I would be at 38,000 in 2 years off of $12,000. So $24,000 or so tax-free. And that's only an example, but my point is tax-free gains. And when it compounds over the next 25 years, and if you're younger, if you're only 18 years old or 20 years old, I mean, that's 40 plus years of compounding growth. Now, because I can't touch that for 25 years, I also have a standard brokerage account with TD Ameritrade. And that's because my investment plan is to retire in 10 years off of my standard account. So we'll see how that works out for me. The investment account would end up being the long-term growth, making me wealthy as opposed to well off. So it's said that, to give you a little perspective on that plan, it's said that 15% gains is pretty average year over year if you invest in the S&P 500 index. I won't go too in depth into what that means. I mean, just type in S&P ETF. I don't hold any anymore. Vanguard has probably the best one out there. So if you want Vanguard S&P 500 ETF. So the plan is 15%. If I accumulate $1 million in my brokerage account, I plan on doing that within 10 years. If I can get to $1 million, I can then transfer all that into a safe S&P 500 ETF, earn 15% on average, and that's $150,000 of income per year. I could easily live comfortably not working on $150,000 per year. So that's my short-term plan. And then by the time I can dip into my Roth IRA, I should be wealthy to the point of not only living comfortably, but doing whatever I want, or nothing at all if that's what I want. So that's my plan. But so Roth IRA and a standard brokerage account, I hold both. Now I'm going to talk a little bit about the smartest people in my eyes, and that's the smartest people as far as investing goes, and business and innovation. These are the people that I pay attention to when it comes to future predictions, future visions of the world. These are the people that I invest in, basically. The first one, I believe he's the smartest man in the world, to be quite honest, and that doesn't necessarily mean he's always the smartest man in the room, but as a whole, yeah, he's a physicist. He's literally a rocket scientist. He surrounds himself with enough people that innovate at such a rate, such a pace that nobody's keeping up. People can't even comprehend it. That's why, if you go back and watch all the stuff, people just really talk a lot of crap about him on mainstream media, and he's just proven them wrong time and time again, and he will continue to. There's still so many skeptics out there. I'm sure most of the people watching this video are skeptics. If you have any prejudices against Elon Musk, I would really suggest you watch his interviews, not watch what the media says about him. Actually search out videos of him. You can go on YouTube and just type in Elon Musk interview, Elon Musk, and look for his actual videos, his interviews. And he's very smart, he's very honest, he's very open-minded, he's very focused. So if you have any prejudice against him, and especially just recently he became the wealthiest man in the world, don't hold it against him. Watch a video, I'll put a link in it below. A guy named Dave Lee on Investing did a response to Elon Musk becoming the wealthiest man in the world. And it's very compassionate, it's very eye-opening to how much Elon Musk doesn't care for money for his own comfort, luxury, or enjoyment. Elon Musk's luxury is sleeping on a conference room floor of an unfinished factory in Germany. I watched an interview where he was in Germany to accept an award, and the host asked him, so where are you sleeping tonight? He just laughs, says, on a conference room floor. And the interviewer says, alone? And Elon just laughs and says, is there offers? He's really funny, but he's honest, and his reasoning for that is because then he's at the heartbeat of his of what is happening. He can see who's there first, who's there last, what's actually happening, what problems are coming up, what he has his finger on the pulse of his business. And as far as an investor goes, that's what I want from a CEO. Honestly, his enjoyment is tripping balls at Burning Man. He is very open-minded. He is very enlightened. He's very honest. He doesn't talk to mainstream media anymore because they would only try to bring up questions about a failure. And that goes back to humans' desire to not look ridiculous. Most people are afraid to try something because of their fear of embarrassing themselves. Where Elon Musk, like I was saying earlier about innovation, nothing was ever innovated without failures. It's about learning from your mistakes and moving forward. So he would go on media and they would always just bring up mistakes that happened or issues that happened, where when Elon Musk goes on to YouTube or conference calls or earnings calls, he prefers to talk to people like you and me, the small-time investors, the YouTubers, the kids that are actually interested in space travel and electrification. He likes to talk to those people because they ask questions based on the future and what he's actually working on and where he found solutions to problems, as opposed to just getting trash talked about him about past issues he's had, as opposed to where he's going from here. And trust me, when they would ask him such questions, he would just give an intelligent answer. And these intelligent answers about where he's taking the company from there and how he learned from his mistakes have always come true. He always figures out the problems. And like I said, that's where I'm going to put my money. He literally landing rockets. Think about that. Lockheed Martin and NASA weren't landing rockets. And it was impossible. And now Elon Musk is landing rockets. And if you see that video where one exploded, that was still a success. That was only a test, and every single thing worked except for the actual landing, and that's not the worst thing in the world. Like I said, it was only a test. they've got one rocket. I can't even remember how many times it's landed now. I want the rocket's gone up and come back down and landed. They're just continually innovating, and when you're innovating, little things affect other aspects of it, and sometimes things blow up. He expected it to. He's basically said that the test was 98% successful. This rocket, they literally got to belly flop on its way down, and that was meant to happen to create more air resistance to slow it down naturally, before then straightening it back out and using thrusters to slow its descent at the last minute, and then aiming it. I mean, if you watch the video where it explodes, that was an amazing attempt. A very successful attempt, all up until the last minute, and it was a hell of an explosion anyway, so that was entertaining in itself. But I'll stop there. It's a huge rabbit hole to go down. Speaking of Elon Musk interviews, he went on the Joe Rogan show twice, both of them amazing. And that was also another one where the mainstream media really tried to trash him because he smoked weed on the Joe Rogan show. Who cares? He's the smartest man in the world. He's literally landing rockets. Weed is obviously not affecting him. And he's doing it in a state that it's legal in. So if you're that short-sighted, then fine, keep your money to yourself and I'll get rich. You can go down that Tesla rabbit hole, Elon Musk rabbit hole yourself. I mean, even look up Elon Musk's Twitter response to becoming the richest man in the world. It's quite good. He basically said that half of his wealth is slated for problems on Earth, and the other half is for colonizing Mars to prevent a catastrophic extinction of the human race due to a meteor or World War III. So he wants us to be a multiplanetary species. That's where I'll stop with Elon Musk. I could go all day. The next smartest person that I listen to, his name is Chamath Palihapitiya. He is a modern day Robin Hood. He's trying to educate the broader masses on investing so that we can overthrow the old guard, the industry leaders, the people that took money with no regard to human life or sacrifice, who took money with no regard to the environment and the destruction that it's going to leave in the coming generations, no regard to destroying a whole country just to open up contracts to rebuild it. No regard to having the money to innovate to sustainable energy, but rather using that money to try to bury the companies innovating and just sitting back and continuing to collect the way you have for the last 100 years. And with that, that's a reference to oil companies. They could have literally taken their billions of dollars. ExxonMobil was the highest valued company in the world in 2009. And now, since then, it has been on a decline. And now Tesla is more valuable than ExxonMobil. They could have easily taken all that wealth and bought Tesla, had bought every solar company, and bought every wind power company. And if they had done that, they were in the mindset of destroying that technology, of burying it and impeding innovation, where they could have taken that and continued it and transitioned to sustainable energies on their own. But instead, they're going to get disrupted, and they drug their feet in the sand for too long, like little babies, or in denial that it was even happening. So that's who people like Chamath are trying to dethrone, and he's doing it through educating people like you and me. You should listen to his speech to Stanford students, where he talks about the power of influence based on money and how you should take it upon yourself to, in his words, get that fucking money. He's basically saying if you have enough money, you have the influence. Even if you don't want it, you can use it or not use it to your advantage. If you basically just don't want to be influenced over, if you have enough money, you can buy an island and keep to yourself, and basically nobody will mess with you. Short of actually breaking laws, and even that, every one of you know, don't be naive. Money can buy you out of breaking the law too. So the power of influence based on money, and he wants to get that money into the hands of people who empathize with the world. So what he does is he brings companies to the market through SPACs, which is a special purpose acquisition company. So they go onto the stock market with a ticker symbol, a generic ticker symbol. With him, it's always IPO and then a letter, IPO A, IPO B, IPO C. And that's a blank check company. So that goes onto the stock market. He puts in $100 million of his own money, and then he also sells the rest of the shares to the market at $10 a share. He raises I believe it's about $5 billion on most of them. Sometimes it varies, but on average about $5 billion. And then he takes that $5 billion and tries to find a technology company to invest in. And once they merge, once the blank check company merges with the technology company, the ticker symbol changes and it hits the stock market. I've bought the IPO that turned into Open Door. I bought IPO C the SPAC that turned into Clover Health, also Desktop Metals. He also brought Virgin Galactic public. He's going to do at least 26 of them. He said he wants to go with A through Z. I think he's on G right now. I don't own the last couple he's put out there because I've been investing heavily in ARC G. But I do plan on scooping up a couple shares. With his, I generally put about 1% of my portfolio in those because I really do believe in him, and I believe that he knows how to evaluate technology companies very well and the influence that they're going to have on our future lives. And one of the reasons I do believe in him, that he's out there to help us and not just himself, because obviously he's trying to make money himself. He only makes money on his investments. He does not take any management fees doing the SPAC. He doesn't charge the company that he merges with any money. When you buy his SPAC, you don't pay him any management fees. He invests in the companies. He puts $100 million into the SPAC himself, and then he leaves it there to ride. If the companies make it, he makes it. If the companies fail, he fails. And that's the kind of person that I want to invest my money in. He's actually got skin in the game. And his track record is very good. And like I said, he's very open. He tells you everything he's thinking and why he's thinking it and his perspective on it. And they have a lot of open discussions with many different smart people, so you can hear arguments against his points of view or arguments for his or vindication on his predictions. He's also quite savage. Like all these people that I'm going to talk about are absolute savages to the media. Whenever they try to troll these investors, these innovators, they always come back with such a smart answer that makes the anchors feel stupid. It just leaves them speechless because they have no comeback, because they knew they shouldn't have asked such a stupid question, trying to coax an answer out of them, make them feel embarrassed about something. They have nothing to feel embarrassed about because they're on the cutting edge. They're the ones taking the risks, and you're never going to hit you're never going to hit 100% right. But when you're hitting 80, 90% right, that's substantial, especially when it's such innovation that has astronomical gains. So that's Chamath Palihapitiya. Very big fan of him. The next one, Jeff Bezos. He's the owner of Amazon. Basically, he, like I said earlier, he was reinvesting in himself. He started as a book company in the 90s, and then when that made money, he invested it, built Amazon.com. Now we're even watching his TV with Amazon Prime. We're using cloud computing with Amazon Web Services. He owns Whole Foods, so now he's into the food industry. He's trying to get into the pharmaceutical industry. Well, he's in the pharmaceutical industry, selling, I mean, just like he's competing with Walgreens and CVS, but delivered to your door and at a better price. There's a video of him from the early 2000s. He was on 60 Minutes, and the interviewer was sitting in the passenger seat and Jeff Bezos was driving, and the interviewer looks over at him and he says something along the lines of, I know this isn't polite, but now I'm only paraphrasing this. So he says something along the lines of, I know this isn't polite, but you're worth something like $10 billion. And Jeff Bezos kind of laughs and he's taken aback, kind of like, yeah, this is kind of not cool to talk about. And the interviewer says, so what's with the Honda Accord? And Jeff Bezos just laughs and he says, this is a perfectly good car. This guy's worth $10 billion and he's driving around in a Honda Accord, driving himself around. And that's because he was cash poor. He took all of his money and reinvested it in the business, which is what Elon Musk does. He is the wealthiest man in the world, and yet he's broke because all his money is tied up in Tesla. If Tesla fails, he loses everything. He goes from the wealthiest man to the poorest man, basically. I mean, obviously not the poorest, but, well, maybe because of the amount of debt he's taken on to sustain living without any actual cash. He gets zero money from Tesla. It's all stock options, and all those stock options are locked up for like 5 years. He's not even allowed to sell them. So that's the same thing Jeff Bezos did, and now Bezos is astronomically wealthy. Amazon stock is, I think it's about $3,200. So I like innovators that are also set on reinvesting in themselves very heavily. Last but not least, I'll talk about Cathie Wood. I already talked about all her ETFs. She is probably one of my favorite people to listen to as far as investors go. She's an absolute savage on the media. And what I mean by that is all the way back in 2014, it's 6 years ago, Tesla was the redheaded stepchild. Tesla was a dog getting kicked by a bastard owner on the media. And Cathie Wood, with all her research and all her conviction, would go on CNBS and CNN and Fox News and any other mainstream media publication owned by the people that advertise the Fords and the Chevys and the oil companies and the whoever else, basically who Tesla's disrupting. And the media would just trash her. They would talk so much shit to her. They would bring up so many questions that she would give answers to. She would give her research, and these people would reference the past when they wouldn't recognize that people like Elon Musk learn from the past and innovate towards the future, and they just kept pointing to the past, and Cathie Wood would point to the future and these S-curve adoption rates and these declining cost curves, and actually show research and try to share it with everybody, and they would just act so unprofessional. I mean, there's one where the anchor said her claim, they were outlandish claims, and like basically accusing her like very viciously of being a liar. Those are outlandish claims, they said. And now 6 years later, she's vindicated and has been right all these years. And now these same people that were trying to troll her, and she would just come back with actual facts and knowledge, and shut them up, even though they would try to argue the same fact that they just said without any evidence past the past, other than the past. Now these same people, these same CNBS and CNN and Fox News, all of a sudden they're singing a different tune. Now Tesla's in the S&P 500 is as if that changed the core business. The business has never changed. And that's the point of earlier with the stock is not correlated with the company in the short term. The company has always been innovating. The company has always been worth this. It's just the mainstream media was holding it down. And why they would want to do that is because if a company on the stock market wants to raise money and they're not worth very much money, they can't raise very much. So let's say they're a $1 million company on the stock market and they want to raise $1 million. They would have to dilute their stock 100%. So now your one share is only worth a half a share. But if you're a $1 billion company and you want to raise $1 million, you only have to dilute your stock by 0.1%. So by keeping the stock price down, it effectively keeps the company from being able to access equity markets and raise more capital to expand the business. But now in 2020, since Tesla has finally gotten its recognition, they can freely raise capital, which they did 3 times in 2020. And now they have over $20 billion in cash on the books. To give you some perspective, it only cost them about $2 million to build a factory. They could build 10 factories in cash. And they build those factories in 1 year. So money is no longer an issue for them. Yeah, she's absolutely incredible. Again, with Cathie Wood, go down that rabbit hole yourself. Look, ARK Invest has its own YouTube channel where she does regular videos talking about the economy on the macro level, which means on the bigger scale, the opposite of macro. She also talks about specific stocks and what happened in them, if anything major changed within the last time since she released one. Her analysts that work for her also go on YouTube and talk about their specific sectors of research to get a little more in depth. She'll interview, like I said earlier, CEOs and doctors and stuff, asking them about their technology and where it's at. It's very entertaining. It's very informative. It's pretty crazy to go down those rabbit holes. Last thing before I close this off, well, 2 things before the last thing. First is the people that I pay attention to on YouTube. The first one is Anthony Pompilano. He is my #1 source for Bitcoin. I will put a link down below to a video called What is Bitcoin? It basically will go in depth for about an hour on where Bitcoin derives its value and how it all works with blockchain technology. The next one is Dave Lee on investing. He's absolutely brilliant. I didn't talk about this earlier with these innovators, but Cathie Wood, Jeff Bezos, Elon Musk, Dave Lee on investing, they all use first principles thinking, which is a physics technique of not reasoning by analogy. When you trying to create something new, you cannot compare it to something old. You have to think from the ground up of what is the essence of what I'm trying to create here. Reasoning by analogy, by definition, stifles innovation. And Dave Lee uses first principles thinking to analyze companies. For instance, I'll listen to an interview, or let's say an interview, and I'll get what I get out of it and think, oh, I would have asked this question, or I would have asked that question. and then he'll do a follow-up video, and the questions that he comes up with are so much, not to say better, but I would have never thought of them. It's helping me to train my own mind to think from a first principles aspect of what is this business and where are they going, not comparing them to another business. That's also why most analysts have gotten Tesla wrong, because they see it with 4 doors and 4 wheels and they think it's a car. Tesla's not a car company, they're an energy company. It just happens that they make cars for now. They won't always make cars. They'll pump out their robo-taxis and then that car business will be done. Maybe it becomes a small aspect of it. Maybe they sell the platforms to other car companies, and other car companies are basically coach builders. But it will be such a small aspect of their company in the future. To think of Tesla as a car company now is even wrong. Just to give you an aspect of how reliable a Tesla is compared to a normal car, and how little maintenance they need. And like, when I think of a gas car with 200,000 miles, you think it's about on its last leg, pretty much. And there's plenty of cars that'll go past 200,000, but it's on its last leg. A Tesla at 200,000 miles, the only thing that has been changed are the tires. There are no brakes. There's only one moving part in the motor. Literally, tires. Teslas are being built to go 1,000,000 miles. So once these cars start rolling out, the car industries, as far as sales per year go, I believe the number of cars sold per year is 100 million cars, and there are 2 billion cars on the road. So that means it will take 20 years for us to change out the entire fleet of cars. But once that happens, that 100 million cars produced per year will be lowered substantially. And Dave Lee on investing really brings up some points that, like I said, I would have never thought about. Another one is a YouTube channel called Solving the Money Problem by Stephen Mark Ryan, and it's really in depth. If you go to his latest videos, you might think he's full of shit, but in my advice would be to go to his channel and then sort the videos by oldest first and start watching through his videos from the beginning, and you will see as the year goes on how right he is. And it is phenomenal to see how correct his predictions are for the way the stock market's going to react to Tesla, what Tesla's core business is going to do, the numbers that Tesla's going to produce and hit, the way the analysts are going to change the way they talk about Tesla. So I'm a big fan of Solving the Money Problem, and that's through watching it over the past year and seeing how right he is about his predictions. Tesla Daily is another channel by a guy named Rob Maurer out of Milwaukee. This one's a little bit more technical. It's a little bit more like watching the news, but only Tesla specific. It gets much more into the core business in and of itself. Some people might find it a little more boring, but me as an investor, I like to hear the actual nitty-gritty of it, as opposed to just the fluff that some people give you. Even though it's all facts that other people give you, this is facts without the fluff. It's just the numbers. It's just what's happening. It's just what happened. So I like to get the raw data from him a lot, and from Kathy Wood, but he does it, as the channel is called, Tesla Daily, pretty much daily. Another channel is Hyperchange with Galileo. He's out of Seattle. I like him a lot because he has a very unique perspective, and he's very smart, and he talks to a lot of people that are very smart, like battery experts, just to find out like where battery technology is, and You know, all kinds of experts, not necessarily Tesla specific experts, but just industry experts. He also has almost a direct line to Elon, you could say. When he tweets at Elon, he gets responses from him. During earnings calls, he gets to ask questions, which so does Rob Maurer. There was something called Battery Day that happened last year. It was like a conference that happened in a parking lot, and everybody was in their own little Tesla while they did this presentation. There was a Q&A at the end of it. He got to ask questions there. Or maybe that was Autonomous Day that he got to ask a question. Yeah, it was Autonomous Day. And they're very smart questions, and that's why Elon comes back to him and answers his questions time and time again, because he is a good source of intelligent questions. And the last one for channel is more renewable energy, clean energy, green energy specific. It does encompass Tesla. They actually have episodes called Tesla Time News, but it's not just, the channel itself isn't just about Tesla. It's green energy in general, and it's incredible. That's where I found about the Australian power pack, the Hornsdale Power Reserve. They've been doing it for like 5 or 6 years. I actually went back to their old videos and watching that and what they're talking about 5 years ago, and it's phenomenal what they talked about then, and to see where that technology has taken us now. Like now, the technology they were talking about 5 years ago has already been implemented, and we're past it. We're on to the new innovation. So as I watch the up-to-date ones, seeing what they're talking about for future technology, with regards to their track record, I put a lot of weight onto what they're talking about and what they're saying is being innovated, and how people are adopting. They talk about a lot about the public adopting technologies and its usefulness. They're the ones that took a road trip in a Tesla, a round trip across the country and back from Boston to San Francisco and then down, just to test out the supercharging infrastructure. So I like that one a lot. It's really funny too. They do some really funny stuff on Now You Know. So that's the end of that. The last thing I'll do, I'll put up on the screen here, is actually all my portfolio holdings, just so you can have an idea what I'm invested in. I hope this was useful. I hope you got some information out of it. I hope it gave you some confidence. If you want to go down a little more of that rabbit hole, you can message me, contact me, comment, and I can give you more sources to research. Or maybe even answer the question myself if it's something I know right off the top of my head and it's not too complicated. I know this video probably went about an hour and a half or 2 hours by now, so good luck.